Hello, everyone. Rajiv here. We're glad to have with us some expert panelists who will kind of guide us in terms of what are the client expectations from an audit. However, before I kind of introduce the panelists and myself, I'll just kind of brief you all a little about our firm. Our firm is Affluence Advisory, which is an ISO 9001 certified firm. We kind of provide, we are a multidisciplinary firm established with a vision to provide end-to-end services. The affluence team consists of chartered accountants, company secretaries, corporate laws, management graduates, actuaries, etc. And we kind of try to deliver quality services and assistance to the clients for over 2 decades. Now, with great pleasure, kind of, I introduce the panel today. We are going to speak on client expectations from internal audit. Uh, so, Mr. Indrani, will you please introduce yourself?
So very good morning to everyone, to my fellow panelists and to you, Rajiv, and to the Affluence Advisory team. And of course, very good morning on a Saturday morning to all the participants who are there. My name is Indranil Roy Chaudhary. I have about 3 decades of experience in the healthcare industry, starting from pharmaceuticals right at the ground level to medical service delivery, including diagnostics and now dialysis delivery. Currently, I lead Apex Kidney Care as our director and the CEO. We are India's one of the largest dialysis service providing company. We provide maintenance hemodialysis to chronic kidney disease patient, in common man's term, kidney failure patients. We run about 230 clinics across 120 cities of the country. We have an employee strength of about 1,600. We operate 1,700 dialysis machines, and we have so far delivered more than 5 million dialysis. Basically, an organization founded and promoted by clinician nephrologists, but now they sit on the board and give a strategic direction to the organization. And we also have private equity investors like Tata Capital and Blue Earth who sit on our cap table. So that's in short about me and my organization. Back to you, Rajiv.
Yeah. Mr. Rakshit, would you do the honors of presenting yourself?
Of course. Thank you so much, Rajiv, and a very good morning to all my fellow panelists, as well as all of you who have joined in. Really appreciate you taking time off for this specific webinar. I'm Rakshit Rangarajan. I am the fund manager at Inviga Healthcare Fund. We're a $50 million thematic healthcare focused fund that is executing a two-pronged strategy. On one side, we are driving control deals and buying out multi-specialty hospitals in various parts of Tier 2 India, with the aim of consolidating and creating a nationalized platform, which is a clinician-driven, multi-specialty hospital service provider, sort of an ecosystem that we're trying to stitch together. And on the other hand, as much as we invest in multi-specialty hospitals, we also take minority positions in adjacencies around the supply chain of the healthcare services ecosystem. And we bet on mid-market, high-growth opportunities in the emerging healthcare context, including devices, biotech, and health tech. I carry 17 years of experience almost entirely in the healthcare financing, investment banking, and investing space, working very substantially in the hospitals ecosystem. In my prior avatar, I've also managed overseas transactions in healthcare and education across the jurisdictions of USA, Singapore, Dubai, and Malaysia. I think the conversation that we intend to have today is extremely relevant because it's something that we come face to face with on a day-to-day basis. Internal audit, its relevance and its importance in creating value sustainably. So I'm really looking forward to this conversation. Allow me to hand the mic back to you, Rajiv, and best wishes.
Thank you so much, Rakshit. Our next panelist is Mr. Graciano Pinto. He's been an old friend. He was with me in Aneja Associates for a number of years. We work together. Pinto, please introduce yourself.
Yeah, hi, good morning to you, Rajiv. Good morning, and thanks for this wonderful opportunity. Good morning to my fellow panelists and to everyone who's logged in on a Saturday morning. Yeah, and myself, I'm a chartered accountant having over 17 years of experience and a certified internal auditor. I worked largely in the internal audit domain for manufacturing clients, service sectors, largely in paints, in pharmaceuticals, in engineering products, in chemicals, as well as pulp and fiber industries. Post Aneja Associates, I moved into the corporate sector. I now head internal audit for a listed company by the name of Everest Industries. It's an 1800 crore company, and that's about me. I report to the audit committee chair. So from that perspective, I hope I'm able to bring some insights on independence of the internal audit function, etc. Over to you, Rajiv. Thanks once again.
Yeah. Hello, friends. I'm Rajiv here. I've been a chartered accountant since 2001. My bread and butter has been internal audit throughout my career. I started my career with Sharp and Dan and Associates. Then I moved to Aneja Associates in 2002. I was a director in Aneja Associates by 2004. Up to about 2020, I was with Aneja Associates as director internal audit. Then I joined RSM as an director internal audit for their internal audit and risk advisory services. Subsequent to that, I've kind of moved to Affluence, the third stint of my career. In about 25 years as an internal auditor, I've had the fortune of auditing some of the Fortune 500 companies, top 100 companies in India. I've worked a lot in the Adani Group. I've worked a lot in the Grasim Group. I've been the head internal auditor for category Southeast Asia and Marico, etc. My specialization has been manufacturing and service. And further, I have had a lot of interaction with pharma clients, FMCG clients, and the real estate. So these have been my specialization over the years. First and foremost, let me apologize upfront. Not the most ideal way to kind of celebrate the Valentine's Day. I know I'm married. My wife's also a little upset with me for doing this on Valentine's Day, but and thank you all for being considerate enough to join us on Valentine's Day. But all the kind of schedules match this way. The stars align for 14. Before we kind of get into the discussion on the client expectations from internal audit, I just thought I should define a client for an internal audit. So for any internal audit, there are four sets of clients. The first set of client is the auditee himself or the lower level management who's actually executing the process that you are auditing. Above that is the HOD, the head of department, or his boss, as you may say it. The third level of the auditee is your top management, which is the CEO, CFO, MD, and finally it's the audit committee, the board of directors. So these are basically the four levels of clients for every kind of organization that you audit. What we're really focusing in this discussion today is addressing the top two levels, which is the CFO, CEO levels and the board of directors. Expectations from each of these levels are fairly different. Typically at the auditee level, at the HOD level, it's process improvements. They're a little more critical of our observations. Their vision is different. They are more concerned about how it impacts their work rather than how it impacts the company. Moving ahead, things are different, and that is what we're looking to discuss in detail. Internal audit has changed a lot over the last maybe 20, 25 years that I've been doing it. And it is always great to have the perspective of people like Mr. Indranil and Mr. Rakshat, who are actually on the other side of the table. Mr. Pinto is also an interesting example because he has actually been on both sides of the table. He is now a part of the company. Earlier, he was an external auditor. I would love to understand how the roles are different in both these places. So I'll let Mr. Indranil, just to kind of brief in terms of a broad idea of what you're expecting from internal audit. We do that and then we kind of get to specific questions.
Yeah, thanks, Rajiv. So you rightfully brought in the changing role of the internal audit and how the top management needs to look at it. Now, so views I'm going to share are the views that I have over the past so many years of our governance for the entire organization and leading organizations and being a part of the board. So in my view, the CEO, the top management look at the internal audit as a strategic partner. That's the changing role. It is now a strategic partner which will protect value, enhance value, as well as provide foresight and just not hindsight. Earlier, it was primarily hindsight, but now it is more focused on foresight. So let me come to this quickly. What do we mean by protect value? So governance and controls, the assurance to be given to the top management that the governance, the risk and controls are in place, flag the red flag ones to be raised, and what are the probable compliance risk, and the ethics, the fraud prevention, as well as the whistleblower oversight. Now, to break it down, these are big terms. To break it down, if you look at the KPIs, so what percentage of high risk areas are covered annually? And how many of the critical issues identified are before impact actually, and repeat high risk year on year as the audit goes year on year? So what are the repeat high risk things? In terms of enhanced value, it has to be practical, business focused recommendations, not utopian. Process efficiencies and cost optimization becomes the key in every business, whichever we look at, because there's a ever increasing pressure of improving margins. So cost optimization is always the key, and simplify the control system, because no one likes a complicated control system. Now, these can be done through data-driven insights using analytics and the very modern technologies that we have. And the KPIs for this can be what percentage of the recommendations are actually implemented by the management in reality, what has the value been unlocked in terms of cost savings, the risk reduction quantified, as well as the management satisfaction score with the CEO, CXO level feedback. The enabling foresight part should include key and emerging enterprise risks. That's very, very critical. Alignment with the organizational strategy and growth initiatives. And this maybe we can discuss later. This is very critical, that strategy and growth initiatives and how do we align with the evolving risk, and insightful support on major decisions and transformations. And the KPIs for that can be percentage of audit plan aligned to top enterprise risks, advisory engagements of strategic initiatives, and the emerging risks. Execution is a key for any strategy. And so execution excellence, the risk-based audit planning, that's critical. The clear, concise, and prioritized reporting, that is very, very critical. And these are, in my view, along with the robust follow-up and the closure of discipline. So percentage of audits delivered on time, percentage of high-risk issues closed within the agreed timeline with the internal audit committee and the management team, and average time to close critical findings. So in my view, the bottom line, internal audit now should provide to the CXO level, to the CEO and the board level, the confidence of today and the foresight for tomorrow, along with a value creation. So that's where I will stop, and I will request my fellow panelists to add their view.
Wonderful, Mr. Engineer. Actually, you kind of almost defined the KPI for internal audit. Rakshit, your views, please.
Of course. Thank you so much, Indraliji. It was lovely to hear that from you. From our perspective, I'll tell you how we look at internal audit. Let me give you a metaphor of a business as a cycle, as a bicycle. And so much of our emphasis when it comes to value creation goes into propelling the cycle forward. There are two elements to how a cycle is, one can ride a cycle. One is propelling it forward by pedaling, and the second one is maintaining balance and ensuring that it is safe. Internal audit plays the role of ensuring that there is balance, and this metaphor that I have very easily poached from Sajeev Sanyal. I heard him talk about this in a different context a few days back, but I think it applies very, very genuinely to the context that we have at hand. So much of value creation is now focused on ensuring that value creation is sustainable. As the private equity venture capital markets have also evolved in India, people realize that they need to eventually, as a venture capital investor, you realize that you've got to sell this in a better context to someone who is willing to bet on the credibility of the platform that's been created, of the business and the enterprise, and a long-term, sustainability to the value that's been created, along with further prospect for growth, is handed over to someone else at the time of an exit. And that has uh, brought everyone's focus towards functions like internal audit, which today are very, very clearly a strategic lever. When it comes to businesses like hospitals and healthcare, as Indraji will only agree, it's a very, very heterogeneous ecosystem that we are dealing with. On one side, there's regulatory and government oversight. There's a doctor-patient provider sort of an interaction where there's a knowledge asymmetry. There are several instances of practices which bring into the fore questions on ethics, on values, and somewhere organizations, especially those that intend to scale and play a long-term game, need to ensure that there are processes that ensure that they go about their business in a manner that's first of all safe without exposure to disproportionate risk, and secondly, also ensure that these processes are time and again tested, adhered to. The relevance of process also from time to time needs to be brought into question. The single department that's capable of anchoring these conversations, provoking these conversations both at the ground level and at the boardroom, is internal audit. And that's the pride of place that they have well and truly earned today. I am quite confident that 15 years back, this may not have been the case. A lot of conversations would have been far more, I would say, broad based, less nuanced. But today, boardrooms are willing to get into specifics, all with the intent of ensuring that a sustainable value creation platform is what they end up creating. So when it comes to our majority deals as a healthcare fund, we are very, very clear on the presence of internal audit as we walk into a deal in the first place. In a post-investment context, especially in minority investing sort of situations, we use internal audit to keep conducting internal diligences. We want our portfolio companies to be prepared to raise capital compatible with the contemporary wish list items that private equity investors want when it comes to capitalizing the balance sheets that we have already invested into. So often we find situations where we are evaluating a deal, there's already a venture capitalist there, and there are skeletons that are tumbling out of the closet. You can't blame anybody. There's a founder who is trying to build a business in a very noisy environment, in a highly competitive environment with lack of access to resources and time. You have a venture capitalist who's also crunched for bandwidth. So all said and done, internal audit helps ensure that the wagon stays on the track, and irrespective of the fact that others may have differing priorities from time to time because of how, as I mentioned, noisy the environment is. Internal audit ensures that we remain anchored to certain fundamental tenets of the value creation model that we have agreed between portfolio company and investor. And that's essentially what we look forward to. It's something that we welcome, and with the passage of time, I'm sure there's a substantial amount of nuance that'll enter this ecosystem. So I'm happy that we're having this conversation once again. Back to you,
Wonderful, Rakshit. Yeah, wonderful, Rakshit. Pento, you want to play the other side? I mean, what are these struggles or these discussions from an internal perspective?
So yeah, Rajiv, firstly, I'm happy to hear the views of both Rakshit and Indranil, and what they look for in internal audit. And it's of great pride to know that, the expectations from people like Rajiv and myself are add value to your day-to-day, your business and your day-to-day operations. What I largely see is that, the MD, CEOs, business heads, they are largely focused on business. They are largely focused on growth. They are largely focused on profitability, okay, and execution of their strategies. And they definitely tend to miss out on various things in terms of controls, in terms of, the expectations, in terms of designing systems, in terms of, the exception reporting, exception management, etc. And that is where largely I think, they fall back on people like Rajiv and myself, and some of our, also are some of the attendees here who largely might be in the internal audit field. So yes, and we should look at our function as a value add function, and definitely add value to the business, to the controls, to system governance, etc. I just want to add, one thing that I've faced, especially when I go into an audit committee. There's always, you have a 20-30 slide audit presentation, and to be very frank with you, depending on the time that is allotted to you, you may have to finish it in half an hour, you may have to finish it in 1 hour, sometimes you may get 1.5 hours. But at the end of the presentation, there's always some people from the audit committee, the members of the audit committee, who will always come and ask you, is this, and some of this will obviously be confidential, is this the only thing that you have to present? Is there anything more that you want to tell us? Is there anything on softer aspects that you want to tell us in terms of the kind of people in the organization, the kind of the overall governance within the organization, the ethical environment, and do you feel that there's business is being doing is being done in the right way, in the intended manner, within the values of the company? And these are kind of questions where I mean sometimes they're difficult to answer, but the expectation also from the board members and from the audit committee members is something far more than just what you have to present. And that is where you also tend to add a lot of value to their expectations. Yeah. That's it.
Wonderful, Pinto. To be fair, I totally align with what Mr. Indranil and Mr. Rakshit have kind of spoken about the expectations of internal audit. Truthfully, I kind of look to deliver more. But I'll tell you the kind of challenges that I have kind of faced over the years. I had two huge companies who were extremely transparent with the strategy that they were kind of employing. On the contrary, for all major mergers and acquisitions, I was a part of the merger and acquisition team. But that is absolutely like in about 25 years, over about 300 clients, I probably had three companies that were that kind of open about strategy. So, Mr. Indrani, my question is, how do you ensure that the internal auditors are actually aligned with the strategy? And what role in strategy do you see of internal auditors in developing them or in managing them? So you are on mute.
So Rajiv, strategic planning and internal audit, now in that emerging role of internal audit, goes hand in hand. It's much beyond checking controls. It's about strengthening the strategic execution, the managing the risk, and protecting the enterprise value as a whole. See, no strategy can be foolproof without a better informed strategic decisions and fewer surprises. That's the least thing the top management wants. It's a fewer surprises. Okay. So strategic plans must always involve the potential risks that are there. Now, internal audit identifies what are the key enterprise risks, be it strategic, be it financial, operational, regulatory for an organization like healthcare. Not that healthcare is the only in the ambit of every other, but healthcare is too critical about it. The IT and the cyber part of it. Now, India is becoming DPDPA compliant. We have to all be cognizant of that. That's an emerging place, as well as the biggest thing for an organization, which is a reputation. Okay. So identify early. You have to evaluate the risk mitigation effectiveness. How effective is this? And highlight the emerging risk more rather than historical and blind spot. See, historical and blind spot is already what has happened. It's a more of a postmortem. You need to obviously do the postmortem, do the RCA, and take the learnings forward. But more importantly is the proactiveness. So the emerging one is very, very critical for strategic planning. The execution is the backbone of any planning. The effectiveness depends on the execution, right? So strategies fail because of execution mostly. So first and foremost, internal audit evaluates whether the set KPIs are truly measuring the strategic goals, whether they are aligned. The second is whether the governance structures support execution, and whether the resource has been allocated aligned with the priorities. So that's very critical. And ultimately, the implementation effectiveness. In addition to this, the strengthening the governance and leadership credibility. See, internal audit, Rajiv was talking about transparency, ethical conduct, the internal controls, and the accountability mechanisms. All these protect the board's confidence, the investor trust, whether it is any type of investor, a private equity investor or a shareholder, whatever, the investor trust, those are very, very critical. And ultimately, it leads to the overall value chain. Okay. So hence, internal audit has a very critical role as far as strategic leadership, strategic decision is concerned. The more important thing is it can and it always contributes to a sustainable growth by increasing the operational excellence. Okay, process improvement, highlight the cost saving opportunities. These are the things which brings about a sustainable growth. And the independence of the internal auditor, that's very critical, acting as a strategic advisor. So recommendations like digital transformation, key mergers and acquisitions, the new system implementation, or even the major change initiatives that the organization needs to undertake. These are the places where internal audit helps in protecting, validating, as well as strengthening the key strategies of the organization. It's sort of, for me, for someone like me, it is a risk aware sounding board. It's a governance guardian for me, and as well as a strategic execution monitor, which shows me a reflection on the mirror how we have been doing. So that's what I look at the role of internal audit in strategic planning.
Wonderful, sir. But to both you and Mr. Rakshit, we spoke a lot about enterprise risk management. But how many organizations really take it seriously? I mean, a fair question is how many companies even have a formal risk register? I mean, I have been a part of a lot of companies, including some of the bigger names in India. And a lot of companies, even if they have it, it's more like a legal tick than a document which is tied to the actual strategy. So, Rakshit, from your investment perspective,
Yeah.
would you really kind of even look at a formal enterprise risk management, or it's more like a back of a paper kind of a exercise which is carried out? I mean, sorry
Right.
for being blunt.
No, of course, of course. So, and it's a very pertinent question. Thank you for this. See, when it comes to at least hospitals, physical assets have been created. It's a very significant commitment that has gone in towards setting up a large-scale enterprise. I would expect it to be there, as a necessary requirement for us also to derive comfort that it's worth our capital. Primarily because of the fact that there's a good amount of heavy lifting that's already happened into creating an enterprise, and if it isn't there, the question that arises is, okay, is the founder, does he not have the temperament to, build an institution? Is it rather a one-hit wonder sort of a project? Or does he have the commitment to then create an architecture around it to support enterprise risk management itself? However, when it comes to many of these early stage initiatives, I can understand the dilemma. It's not so much of a paradox, but it's a dilemma from the perspective that you do it too early. Promoters and investors, even early stage investors, well established ones, are apprehensive that you may end up stifling growth. At the same time, I would like to see, at least green shoots of these concepts finding their way into ecosystems, even when they are at the 10 crore, 15 crore sort of a level, because the extent of risk that enterprises, especially in the healthcare domain, are exposed to nowadays is substantially high. And it only augurs well from a risk reward trade-off perspective that when you're dealing with products that carry that inherent risk, services that carry that risk, you need to then equip yourself to be able to repeatably deliver products of a certain quality or services of a certain quality. So I would like to see at least nuclei of, ERM sort of concepts finding their way into conversations, even when a company has moved beyond the 1 crore and in the 5 to 10 crore revenue sort of a bracket. And that can then gradually metamorphose into a formal set of differentiated functions, including internal audit, etc. But from our perspective, it's an imperative. From our perspective, there are companies today which are well and truly make in India, make for the world. And when you do that chest thumping saying, I'm make in India, make for the world, and you've done all the good work in terms of creating high IP, high value addition sort of enterprises, then it's only matter of follow through to ensure that you then protect all of that, which the wonderful work created by creating this substratum for growth. So that's how I choose to look at it.
See, the perspective here is like, see, I try and give you a practical example. I was the kind of internal audit head for a pharmaceutical Indian company which is global. So far, the Indian pharma companies or the pharma sector in India have had it good. I mean, if you look at the US market, if you look at the Europe market, the kind of legal suits that are filed against pharma companies, uh, it almost becomes like a question of existence.
Very true.
Class action suits, etc. Even with a good kind of an MNC pharma company, I have actually seen the kind of risk assessment that is done for companies abroad
That's
vis-a-vis
right.
those in India. They are principally different. I mean, in one place it is there, in the other place it is not.
Very true.
And truthfully, in my view, the pharma sector in India sooner or later is going to be exposed to these kinds of lawsuits.
You're right.
Uh,
You're right.
Especially you investing, Mr. Indranil, being on the kind of being the leader for a pharma company. How do you kind of see this moving forward?
Would you like me to take that, or Indranil
Yeah,
ji
you,
would?
Mr.
Sure.
Indranil, either.
I'll
Yeah.
just share in 1 minute. See, one aspect which really resonated from what you mentioned before I give this to Indranil ji is regulation also keeps drifting with time. So all said and done, 2, 3 years down the road, the starting assumptions with which you have set up your business may fundamentally change, and a lot of this creep baseline drift in regulatory positions, as well as the interpretation and application of regulation, both domestically and in international jurisdictions, also keeps changing. So basically, then internal audit, and the ERM enterprise becomes a very coherent framework of knowledge give and take between the external environment and the company and the boardroom. The founder can't keep, you can't expect the founder all by himself to keep resolving for sales growth and also understanding the nuances of law and regulation compliance. So, it's a critical function from that perspective. And, what you had mentioned brought this thought to mind, and I thought I should share it with you. We've seen enterprises beautifully built, backed by the best investors, some of whom realized, upon some of the diligences that we went through, that they didn't have certain operating consents. And it was entirely bona fide. They just didn't know. But at the same time, they were carrying this risk for every day of their existence. And
Absolutely.
it can have a torpedoing effect on the best intentions. So these are legitimate risks. We are not saying that you need a continuous watchdog at the behest of investors. It is for self-sustenance. But here, let me take a pause and hand the ball over to Indranilji.
See, Rakshit and Rajiv, so the point we are having a discussion is it's very simple. You can build wonderful businesses, but when you are exposed to such risks, everything can be eroded overnight. So whether it is the founder, whether it is the investor, and whether it is the management team, they need to be cognizant of the fact at the highest level, and this should be their KPI. Now, yes, there has been cases against Indian pharmaceutical organizations, but broadly, I would feel, because we work a lot with the government and we are seeing a reflection in the government's mindset there. For just to give you an example, for my business for dialysis, the government plays a very critical role. You just cannot have a substantial dialysis providing medical service providing organization without the government business. So 3, 4 years back, when we started interacting with the Ministry of Health and Family Welfare, the government's view was basically to address the affordability and the accessibility of healthcare gap, service delivery gap. Now, from there, they are focusing towards compliance and quality. So it's very, very critical for organizational leaders to identify that, because this is going to come very, very soon. And Indian medical service delivery companies are now going abroad. So what the pharmaceutical has been already exposed on the product side, the service delivery side is soon going to get exposed to it. And it's high time that the leadership wakes up to such challenges and be cognizant of everything, have the risk committee, have the chief risk officer in place, and evaluate everything. In fact, in my view, for every board meeting, once in a quarter when it happens, there should be a compliance presentation and a risk committee presentation happening to the board in every board meeting, because most of the cases we know that if anything is going wrong with such cases, ultimately it is the executive director of the board whose neck
Absolutely.
is on the slot, right? So these are the things which is very, very cognizant. Healthcare leaders have to be cognizant about it and be compliant.
No, now let me give you a real life example. I mean, Pinto, you also can chip in this. A few years ago, there was actually, I don't want to name the company quite obviously. They set up a plant in Dehradun, near Dehradun. The whole economics of the plant was in that sector, people work for 12 hours a day. I mean, the whole economics of the plant was on the basis of 12 hours working. As per the labor laws, etc., if you work over 8 hours, you're supposed to pay double over. Uh, I mean, I really do sympathize with companies because I really believe the laws in our company are horrible, not archaic. They're just plain horrible, especially the labor laws, etc. I'm glad they're making some changes now. Uh, but there is a plant which is set up, crores spent. the assumption is a 12-hour working day, which is probably the norm in the area. But from a compliance perspective, it's a total non-dump. So, I mean, from an internal audit perspective, yes, I do flag it. But the moment I flag it, it kind of derails literally the growth plan of the company. So, under these circumstances, from a management perspective, how do you all expect us to react, and how do you all react to it?
So Rajiv, I'll just add a couple of things here to what you said. You specifically mentioned Dehradun. I would add it to the whole of India. A lot of people, for example, you're talking of overtimes. A lot of people want to work 12 hours a day. Some of the people want to work beyond that. There are also certain laws, clauses that say about overtimes, about weekly offs, about limits, quarterly limits, half year, annual limits, etc. And you need to understand the perspective of the person who's working. He's working for money, right? And he wants to work, and most of these people would be migrant workers also. They leave their villages, they leave their families back at their place, and they travel to a different state, sometimes 1,000 kilometers away to earn their bread and butter, right? So yes, you're supposed to flag it off. I'll give you an example of what happened. Our audit committee also insisted, right? So quarter on quarter, you flag it off. You say that so and so things are happening. This is a risk, etc. And this is I would like to keep this in a very close space to say that some of the members of the audit committee first said, fine, you have highlighted it. I want management to tell me, okay, what is the industry practice? How do other industries manage this? What needs to be done as a company to ensure that and see some of these compliances include shutting down your plants, imprisonment of directors, etc.
Absolutely.
Yeah. So they want to know in closed doors, right? How does this risk really get managed by other companies? What are the practices by other companies? What should be done, as an offline kind of mechanism, to manage this risk, to ensure that yes, it's an industry practice. It's a practice that happens. It's far and wide across all the states of India. What should be done really to ensure that uh, the impact of the risk doesn't fall on the directors, whether it is probably managing the labor commissioners, maintaining managing. I will not say managing in terms of under the table or anything, but maintaining relationships with them, uh, ensuring that uh, in case they are I mean, ensuring that you have a great relationship with them to at all times, to so that they do not in any way attack only you, right? And but yes, it becomes a challenge both from an audit perspective as well as from a board and management perspective to really take care of these risks in a very ethical way. So yeah, that's my stand. Uh, Another thing, Rajiv, I would want to also say is that, see, on your ERM framework, you mentioned about the ERM framework. Today, the risk committees want to know, yes, you have and the organization that I work with, in fact, has gone from, half yearly risk, which is risk meetings, which is a statutory norm, to quarterly risk meetings because of certain discussions they want to have on certain risks. See, what really happens inside a boardroom is far different from what goes into preparation of that presentation. You may prepare a presentation of, let's say, 10 risks, 15 risks, 20 risks. What probably gets discussed inside the boardroom is maybe 3 risks, 2, 3 risks. What goes beyond that is, the other risks that the emerging risk. For example, one of the things he said, Indranil said, was the DPDP Act, data protection, right? So the discussion that goes is how are we on data protection? How are we on other emerging risks? Then there is the new labor code that is also coming. They want to know the risk. The risk committee wants to know how does that impact the organization? In what way do things change? Whether it is in terms of cost, whether it is in terms of working with contract labor, whether it is in terms of even changing your entire structure from, I think, for example, now there's a concept of FTEs that is come in the wage code. So it goes just from, like the existing way of permanent workmen, contract workmen, to also ensuring, yes, what else can be done, what are the fine prints in this labor code that really can be is implementable to also ensure that the costs are still managed. Another thing that they also want to look at is emerging risk. In terms of business, what happens if something goes wrong in terms of some regulatory risks, etc. The other things they also want to know about is on digitization. How well, how digitized or how automated, digitized, what technologies are being used by the company to really ensure that things are far more easier in doing business in various transactions, whether it is in automation, digitization, uh, what amount of work is manual, and what is the roadmap of the company to move from manual to automated to far more digitized structure. And these are the things that they really want to know. And these are things of what happened inside a boardroom. Besides the regular risk register that you present to, or you prepare and present. Another thing that they also want to know is, and this is one of the things that happened in my very last risk committee meeting. One of the directors said, "Fair enough, you are showing us so many risks, and we have been discussing this. I want one slide on, besides risk, I want to know one slide on opportunities, right, of the company. What are the positive outcomes, or what are the positive areas of the company where we have an opportunity, but probably we have not explored that opportunity, or we need to explore that opportunity that is probably untouched." And this is also some of the areas that the risk committee members also want to go into. And this just simply shows the maturity of the risk committee, of the members of the audit committee, members of the board. I have also seen, as Rajiv said, he's worked with 300 clients, but he's seen this probably at 3 or 4 clients. So yes, I've also seen some other clients who have risk committees just as a tick mark, have audit just as a tick mark, just from a compliance point of view. But yes, it shows the overall, the boardroom discussions really show what is the maturity of the risk committee, what are the expectations of the risk committee from an ERM and risk management point of view.
Wonderful, Bindu. Friends, whoever are the participants, if you have any questions, please drop them in the chat. Rakshit, coming to you on this question, having whatever Pinto's discussed, how do you assess the tone of at the top? When you're making an investment into a company, I do believe the tone at the top, the culture of an organization. See, truthfully, these are subjects which have really not caught on in India, but these are some of the huge topics which are globally in IIA. These are some of the real big topics, which is what is the culture of a company, what is the tone at the top, those kinds of questions. So, Rakshit, from an investment perspective, how do you kind of assess this? How do you look at this?
Of course. And it's a very, very important question, especially for us, because we come in, we substantially deal with enterprises which are looking for their first institutional raise. And that's essentially where it becomes a watershed moment for the founder as well, even from our perspective, because it's a cultural watershed. There's one wherein the founder, to a great extent, rightfully so, has driven this enterprise and shouldered the responsibility single-handedly. From then on, once institutional money is raised, it becomes a different responsibility and ball game where you're trying to institutionalize, the platform that you have created and, look to scale over a 10, 20-year time horizon. Tone at the top is something that we're very, very sensitive to. We've, walked away from trades where we've realized that there is some amount of closed-mindedness towards, some of the dimensions that we've discussed on this call. But we don't rely on a single meeting. We don't rely on gut feel. What we typically do is to have multiple conversations with both the founder and the senior management in isolation of one another, practically as conversations, not really interviews even, but we are trying to socialize with them over maybe a 15, 20 day sort of a time horizon, and then try to measure the dissonance that we see. To what extent is there a coached Indian Idol sort of a well-rehearsed speech that is being put out? And to what extent do you have genuine issues being discussed, including disclosure of problems that we're likely to face? And we've seen evidence of both on both sides of the spectrum. We've had a founder who laid all the cards on the table and said, "Listen, it's practically like a marriage. Given how marriages are these days, a private equity deal could be longer than a marriage." But all said and done, the founder said, "This is what it is. I've told you everything. Full disclosure. If you're happy investing, if it meets your risk reward criteria, go ahead. Otherwise, it's cool." And we've had those who have played it more, unfortunately, in a conventional way, saying, "Let's see if they find out and talk about it when they do." Which, given the level of oversight that we have, thanks to agencies such as yours and so many others, uh, it's only a matter of time till we have those conversations, which aren't even difficult from our perspective. We have already made up our mind. When we walk into the room to talk about issues that could have been disclosed, but where an easier decision and a convenient decision was made rather than the right one. So tone at the top matters. We look for resonance of that tone within the team that reports into the founder. And if we see any form of incoherence there, which is malafide, we walk away plain and simple. And I'm sure any venture capitalist would. The VCP ecosystem is also evolved to the extent that many of these behavioral traits people are increasingly sensitive to, not so much through heuristics, but even through paradigm. It forms part of the last mile checklist also nowadays. I think it only augurs well that uh, early stage to early growth ventures should equip themselves to address some of these dimensions before they expose themselves to the capital market.
Wonderful, Rakshit. Mr. Indranil, this is the question which is the forever question from an internal auditor's perspective. We often hear that growth and controls are opposites. It's something which I've been fighting with audit committees, CFOs, CEOs. Yeah, there is a balance to it. Over the years, I also have realized there's a balance to it. And that balance is hard to get. I am even upfront in admitting it. But what happens when controls or governance restrict strategic growth? So you're mute. So you're mute.
Sorry
Imran?
for that.
Yeah.
Sorry for that. Not an easy question, a challenging situation for a CEO to manage because growth has to be delivered. Everyone wants growth, every stakeholder wants growth. The CEO is also the custodian of the reputation, of the compliance part, everything we spoke about. So the challenge becomes how to resolve conflicts between the strategic growth initiatives and the compliance environments. But in my view, this can be very well handled if there is a very clear-cut prioritization of what does the organization want, and what the organization wants, basically, it's to a large extent on a CEO or the management team to also go and explain to the founders that what are the risks and what should be done, because many times the founders are not aware of it. They are into many other things, but it's the responsibility of the CEO, who is the custodian. He has to take the metal and do it. So basically, in my view, the goal is to not eliminate the tension, but to govern it intelligently. That's how it can be done. Okay, that's the job of a CEO. from the perspective of a CEO, a structured alignment and not dominance of one over another. You need to find a balance, right? So there can be various ways through which this can be done. First and foremost, classify the risk appetite at the board level. That's very, very important. That's the most important thing. You have to define acceptable versus unacceptable risks. Quantify the tolerance levels wherever it is possible. You have to quantify that and align the incentives within those boundaries. The next important thing is you need to involve compliance early in the strategy design and not the other way around. Design a strategy and then look at the compliance. No. Involve compliance right at the strategy designing level, because this will include compliance and risk leaders in strategic planning workshops, market entry discussion, product development planning, and this shifts compliance from gatekeeper to an enabler. The ownership comes there, right? That's most important. The other thing is, the shift from no to how. And this is important, from no to how, keeping in mind the first thing what I spoke about, the acceptable points and the unacceptable zero tolerance risks. So that's what I spoke about, keeping that in mind. So instead of compliance and others saying we can't do this, the strategic leadership should reframe the question in the way that, what, under what control framework should we be able to do this safely? That's the other way of looking at it for me. So this changes the entire dynamics from a confrontational level to a problem solving level. And then we have to define whether at all we should go there or not. The other important thing is using a very structured risk reward analysis. Instead of debating opinions, doing scenario analysis is important. Cost of non-compliance modeling, the regulatory exposure mapping, these are very, very critical. And most importantly, reputation impact assessment. See, a little bit up and down on the business can be made up in the next year, but reputation once lost is lost forever. That needs to be kept in mind. That's very, very critical. Some organizations not doing well in business in a particular year always has the chance of bouncing back in the next year or in the next quarter. But reputation is like a mirror. So once it breaks, there is a crack always, and people will think 5 times. And I talk of this, it's not that in any other industry it's not there, but somehow being in healthcare always, I have felt that healthcare is like that because we save lives of patients. And reputation is of prime importance for us. So that's important. Also important is the establishment of the escalation and the governance channels. That's very critical. There are certain conflicts which needs to be looked at with legitimate trade-offs, and restructure resolution. That's important. Management discusses it first. If it is unresolved at the management level, it has to be escalated to the risk committee, and the final arbitration need to happen with the board and the audit committee, and the final call must be taken. Another important thing where sometimes organizations go wrong, we keep on aligning incentives to drive the strategic initiatives and to achieve the designed revenue growth and other things, right? But revenue growth incentive versus the risk-adjusted performance incentive, that's very important. Market expansion is important, but that has to come along with ethical conduct. So at the top of the organization, how you set the mindset in the lower layers is very, very critical. And organizations must look at, I know every organization may not be, but must look at short-term profit versus sustainable growth metrics. If you are compromising today, you cannot deliver a sustainable growth metrics. And lastly, very, very important, be very clear about defining the non-negotiables. Even if it means walking out of a negotiation table, so be it. Because we cannot put the reputation of the organization, the name and fame at stake against a business deal. That's not, business deals will come and go. We can create business deals, we can create market, we can create growth, but not reputation needs a lot of time to be created. And it's important in the team to promote a risk intelligent culture. High performance organizations treat risk as a strategic input. It can bring in a competitive differentiator. So let's design that constraint beyond which we will not go, right? And you need to separate ethical risk and a business risk. Those are very, very two different things. The CEO level leadership role becomes very critical, as I said, because ultimately, mostly we see in an organization like us, the CEO is the executive director. So many of the other directors, the investor director, it's your responsibility to go and show them the picture and convince them what is right for the organization. Because the CEO plays the role, it's a integrator between the growth ambition, the governance discipline that we spoke about, and the governance discipline also has to be kept in mind, keeping in the stakeholder trust, because I cannot say I will only do governance and not deliver the stakeholder trust. Rakshit and people will not be happy if I say that your IRR is not going to come. So those are the things. So in practical example, the strategy team sees an opportunity, conflict management, the compliance flags corruption and sanctions risks, and ultimately you go ahead with, you conduct enhanced due diligence, you do implement a stronger control, adjust the entry model right in the beginning, joint venture instead of full exposure. That's very critical. And set stricter monitoring. The strategy thus proceeds with safeguards. Otherwise, the strategy may gallop in the beginning, but it will tumble in the days ahead.
Numerous examples of that where, the growth spurts have been extraordinary. But the moment, then it's a break. I mean, it's a full stop then. It's not even like a comma. And I mean, that's something which we've been kind of observing over the years with a lot of Indian companies. Next question for our friend Mr. Pinto. Pinto, geographically, you kind of audited across continents. What are the kind of specific challenges in India as against abroad?
Yeah, Rajiv. We've worked together we have been to US together, we have been to Egypt and some other countries also together, worked in India also, and plus other than that, I have also traveled to the African continent a lot, and done some audits for some of the companies there as well. See, what is really important is internal audit standards, okay, are global, but application should always be local, right? It's about adaptability. It's not about lowering anything, but it's applying things smartly. Let me give an example. Like, for example, in USA, okay, they'll have a very highly structured governance mechanism. Documentation culture will be far, far higher. Come India, of course, there are strong regulatory frameworks, governance mechanisms is still improving, evolving significantly day by day. But you still see promoter-driven structures. You'll see, in many sectors, you still see including some of the big companies. Don't want to take any names, but you'll see a lot of promoter-driven structures there also. The way you kind of do audit there, the way your focus should be different. Okay, in some places you look at data-driven, mechanisms. Some places you just focus more on the relationship management. Come Africa, you see that the frameworks are still evolving. Some countries are still systems infrastructure developing. I don't know how many countries in Africa may even have SAP, right? So, and SAP is supposed to be the strongest or one of the strongest systems in place.
I might disagree, but fair. Continue.
Fair enough. Yeah. The kind of risks there are far more different. For example, in a country like US, there'll be more of legal compliance risks, which will be given far more priority. In India, there's compliance risk. There'll be some amount of operational risk. Come Africa, you'll see more amount of operational risk, fraud risks. Weak systems probably. You may in these countries you may have to support the control framework, right? And at some time you may have to play the role of building awareness among the clients or the people you work with. At some places, yeah. So it's largely about adaptability. It's not about compromising any kind of independence or diluting any of your work mechanisms or ignoring any kind of red flags. But it's more on adjusting engagement style, more on the implementation approach, the communication approach, relationship management that you build. Uh, I don't know if you recollect, way back in I think 2009 or 10, we traveled to US together. Uh,
San
their
Fran,
expectation. Sorry.
San Fran,
Yeah, yeah.
San Francisco.
So yes. So one of the things that and I was a young internal auditor at that time, right? Uh, one of the things that we saw is that one of the HODs had said, we have a meeting at, let's say, at 8 in the morning or 9 in the morning, I think, and US starts their day pretty early. We start going to the office by about 7:30, reach at quarter to 8. So the work starts at 8, and the relaxation is, I mean, the day slowly begins to end by about 4. People are out of the office by quarter to 5. This person called us for a meeting. He said, "I'll meet you at 8 o'clock." And I think one of our colleagues was 2 minutes late. And not that he just did not entertain him, but he also wrote an email to the entire audit team with his CFO saying that, I was waiting for you at 8 o'clock. You were not there by 7:58. You were not
Yeah.
outside my cabin by 7:58. I came to look for you at about that time. I also looked outside. You were not there. Uh, and that meeting just didn't happen. Imagine working in a country like US or in a very structured framework and environment where and your work is time bound. You're there only for 15, 16 days. You're given a big audit plan. You've planned a lot of work, and something like this happens. It's a big shocker for it was a shocker for all of us, including you, Rajiv. If you recollect.
Yeah, I kind of learned from that, and I kind of tried to implement that here in India too. It's not working. But to me, the principal difference at the risk of sounding a little rude, is I've seen people are generally honest abroad. So if they tell you something is there, it is there. If it is not there, it is not there. In India, you really have to kind of double check everything before you sign off, which is not the case abroad. I mean, that's been my experience in majority of the countries abroad. The last question which I kind of want to ask the board, and please anyone, it's something which has been very close to my heart and which keeps bothering me. What are the kind of expectations from the internal audit team to find out frauds? I mean, how much does an organization see any fraud, and the first question coming to their mind is, what are the internal auditors doing? I'll actually leave it to Rakshit and Mr. Indranil Roy. Both of us are on the other side.
So I'll keep it very short and simple. It's important for a CEO or the MD or the top management to understand that internal audit, what it is not expected to do and what it is expected to do as far as a fraud is concerned. Internal audit is not expected to detect every fraud. Internal audit is not there to prevent all frauds, but it is also not there to guarantee a fraud-free environment. Okay. It is also not there to replace the management accountability, right? So this is what it is not expected to do. It is very important to understand first what it is expected to do. Okay. Now, similarly, what should you expect internal audit to do as far as a fraud case is concerned? Assess whether the fraud risks are systematically evaluated or not. That is point number one, in my view. Test whether the anti-fraud control really works or not. That's important. That's the second piece. Highlight the control weakness that enable fraud to the management team and to the internal audit committee. Detect the red flags during the audits. Promote an ethical culture and tone at the top. Someone spoke about tone at the top. I think Rakshit spoke about when he goes for
Yeah, that was
investment
my
in the
question
function.
always.
Yes, that's very, very critical. So promote the ethical culture and tone at the top and provide assurance to the board and the audit committee. But again, I must come back. We have to be very clear that internal audit cannot guarantee zero fraud, and they cannot serve as the only fraud detection mechanism. The CEO, the MD has to depend on the internal mechanism. It is the management team's accountability, not the internal audit's accountability. So this is very critical. And red flag, if an internal audit is not meeting the expectation, that's also critical, right? Fine. So I'll stop there. I'll request Rakshit to add his perspectives.
No, I completely agree with Indranil ji in this department, and I have precious few incremental points to add. Not much because I am in full agreement. I think two subjective items that can help mitigate this sort of exposure to risk is the ability to hold one's position and speak truth to power. All said and done, the ability to do that in a very scientifically tempered way is a differentiating criterion. And to not simplify observations or cast away observations as outliers, but to look at it with a very, very deep, rigorous spirit of scientific exploration to ensure that that outlier does not become that one instance of, fraud potentially manifesting, which has been cast away rather frivolously in an attempt to oversimplify, an audit finding, so on and so forth. So my sense is subjectively the ability to hold on to one's position irrespective of forum and play that role responsibly. And the second is to adopt a very scientifically tempered approach, which also helps disarm the organization's participants, because then they realize that it's not person based, it is issue based. It's not ego driven or emotional, it is something that is very, very objective. So I think these two criteria will certainly help.
I mean, when we speak about tone at the top, I always kind of share this example. I used to be among one of the audit partners for Tata Power. So once I was just sitting with the MD and just casually having a cup of tea and we were discussing. And he just off the cuff asked me, "Ki, Rajiv, what is your, I mean, from a Tata Power perspective, what is it that bothers you sometimes?" And I just gave it a thought and I told him ki the thing that really bothers me is that I have been in organizations auditing for years. This is the only organization where I've never heard a grapevine of a fraud. Neither me nor my team, we are already doing 30, 35 audits. And and that's just something which I've always been very sensitive to. I mean, I've always encouraged my people to, talk more to people, build relations, be a part of the grapevine. And I told him, yeah, that really bothers me. In spite of being here for 2.5, 3 years, neither my team nor me, we've ever heard a grapevine of fraud. He looked at me and he went to the door and he just picked up a random person sitting there, saying, "How long have you been working in Tata Power?" He's like, "Sir, 22 years. Your father, where was he working?" He said, "Tata Power." He said, "साहब आपको जॉब दे रहे 20% इंक्रीमेंट के साथ जाओगे?" तो क्या नहीं सर, मैं टाटा पावर में ही हूँ. He says 95%, 97% of my people are like this. Similarly, there was one audit which I did for Tata Power, where they hold a lot of land around Lonavala, Pune, Mulchi Dam area for the water catchment areas. So the audit was really kind of looking at the encroachments in the land held by Tata Power. So one of the key things there was going to the Tehsil land offices to get the Satbara. Satbara basically is the boundary of the land. So, I mean, going to a government office and asking for it and getting it in 5 minutes used to always be a surprise for him. So once one of the senior guys at the land office, I just kind of, I mean, he was out and I was out. We were both smokers. So I spoke with them. I said, "How come Tata Power, I get that in 5 minutes. Other companies, it's taken me 7 days. Plus 50 requests for under the table payment." He said, सबको मालूम है टाटा पावर पैसा नहीं देता है. नहीं देगा तो कल वापस आएगा, परसों वापस आएगा. उससे क्या देके खत्म कर. I mean, that's the kind of culture you're looking for in organizations. I mean, it still always impresses me. Okay, audience, any questions, please type it. We'll be glad to answer. We'll wait about 5 minutes for questions because we've already crossed an hour, which was planned. So maybe 3, 4 minutes for any questions, any kind of closing comments by the panel, Mr. Inmend.
You want me to go to the closing comments or should we wait for the questions? Whatever you prefer.
We can go to the closing comments by the time the questions come in. So
For me, I mean, we had a wonderful discussion. I would only say, from the CEO's perspective, from this side of the table, uh, sometimes the blunders that the top management does. I'll give you some examples that will sum it up. Calling the internal audit too late. For example, a merger, a high-stake M&A has failed, and then we are calling the internal audit. What are we doing? A lot has already gone in stake, right? A transformation which was budgeted at X has now become many times more than that. So there's a collapse, and then we are calling the internal audit. We have not included that earlier. A system implementation which is failing, and then we are calling the internal audit, right? So the essence is very, very simple. The internal audit has to be called early so that costly surprises can be avoided. That's one. And the second one, it's the ultimate responsibility of the CEO to ensure the functional reporting of the internal audit to the audit committee and direct access to the CEO and the board. Internal audit must have the direct access to the CEO and the board and zero tolerance within the organization for retaliation against auditors. Because if we are able to do these, then only it will be successful. Then only the objectives will be met. That's what I had to comment. Thanks.
Of course.
okay.
Sure. See, thank you so much for this, Indranilji. From my perspective, I think from a founder standpoint, the choice is simple. If the choice is to build an institution, then the founder is in it for the long haul. And the only way one can build an institution is to bring in these practices as soon in the game as possible. The scale of it doesn't matter, but the fact that it is there to act as the center of gravity for the organization is very, very important. From a financials perspective, it's only important to instill these practices and encourage these practices as soon as possible, in a post-investment sort of a context. The rest of it is all too evident. To wish it away and to treat it as just a box to be ticked will be myopia at the highest level. So it's an imperative, and this conversation that we have had today has really helped cast light on so many dimensions. It's important as investors also to carry an empathy of how various participants in this ecosystem look at it. And through this call, we have had the opportunity of hearing about this through the frame of reference of a founder in Indranilji.
Absolutely.
And also with yourselves, Rajiv and Graciano, as auditors yourselves. So I think it's endowed me personally with the empathy to be able to apprise situations from your perspectives too. In the hope of providing my organization with the right way forward. So I must thank you for having set this up and for your insights.
Thank you so much, Rakshit. Any closing comments, Pinto?
Yeah, just one small comment. One of the most important things, of course, Indranil has already touched on it, is to say that the internal audit should be involved in the beginning itself. On frauds, one of the things that was discussed was that we need to have internal audit is not responsible for fraud detection. And one of the most important things he said, and I want to enhance it a little further, is to say that you build a culture of an anti-fraud environment. Something that probably I thought of adding is you need to have strong whistleblower mechanisms. Okay. And also, consequence management of any kind of fraud that is investigated and has an outcome. The outcome of the investigation is that a fraud has occurred. It is also very important for board management to build a culture to ensure that these are told to everyone in the organization. In fact, in my organization, I see that 5 minutes of our monthly town hall is on all the investigations that have happened during the month or concluded during the month, which is told by the chairman in the town hall. Okay, along with the consequence or the likely, if the consequence, if the action is still not taken, he also goes to the extent to say, in an open town hall, what is the likely consequence that is going to take place. That is one. Second is, I also feel that, internal audit should truly be, whether it is in-house. Of course, if it is in-house, then you're within the organization. Sometimes objectivity can be a question mark. If you're outside, then definitely there's a clear boundary on independence and objectivity. But wherever you are, internal audit should be truly independent, objective, and it can definitely add a lot of value to an organization. It should be called in early, whether it is during system implementation, whether it is during any kind of strategic discussion. You call in internal audit at an early stage rather than after the thing has occurred. That's about it. That I thought I'll just add some concluding comments that were probably did not really discussed during this time.
So we've got some questions. Pinto, the first one is for you. Sir, I want to know the reporting hierarchy of in-house internal audit.
So I started this at an introduction stage itself, and I said I report to the internal audit committee. The chairman of the audit committee, that's a good governance. There's no interference by, there should be no interference by management in any of your findings or anything, or any slides or any kind of observations or anything you want to present. It has to be to the chairman of the audit committee. I have the chairman of the audit committee on WhatsApp, contactable at any point in time. Also, the chairman of the board is, a call away. And that is one of the good things. It should not be definitely not to the MD, not to the CFO. Some organizations have something called as an MD office or a strategy and growth office, or you call it part of the executive team, as the MD's office, like I won't call it as a personal assistant, but a executive assistant. Some people report to that, but that should be administrative, should not be a clear reporting line to anyone in the management.
So, Pinto, just to take this forward, a fairly blunt question. Were you more independent when you were a part of an external internal audit team or now?
As a part of an external audit team, definitely the boundaries were set very clear, right? There was very little anyone could say on independence. Yes, you have to maintain that independence and objectivity when you're inside also. It can be questioned at time, but you should not let
So
it
better
happen.
to be out. So better to be as an external internal auditor.
See, I would say both have their pros and cons, right? When you're out, one of the things that probably the company loses out on is the business understanding, business context. Your recommendations may not really sometimes have that long-term impact as well, right? Whereas when you're inside, the organization tends to benefit more. There are pros and cons to both, right? Another example is, for example, in terms of time, right? Let's say you do a one-time audit for a company, first client, new client. You're probably doing you're doing an assignment, just one assignment based on which you're looking at prospective business. You get 15 days to kind of get that audit done, report out, etc. When I joined, when I moved from an internal audit firm to a corporate, believe it or not, I was given 3 months only to understand the company. The MD had told me at that time, no deliverables. You have 3 months, understand the company, understand the processes, understand the systems, and it gave me a far more, better understanding of the business, better understanding of the plans, better understanding of the people. So yes, there are pros and cons. I from
Oh yeah,
to
Pinto. Had you
to
had
be
you asked
very
me for 3
specific.
months for an audit, I would have probably broken your leg.
So yes, to go back to your question, yes, independence has to be balanced, and you have to, you cannot you cannot compromise on independence and objectivity. You need to demonstrate it far more than what probably you do it in an internal audit firm.
Uh, this was a question by Nishant. I hope we've answered it. He had one more question saying, promoter-based company reporting to CFO, is that in line with independent? It is not. I believe Graciano has already kind of addressed that. The next question I'll ask Mr. Indranil to take it. What are the biggest challenges currently faced on third-party vendor services?
See, first and foremost, proper validation of data for a third-party vendor while you are onboarding. Your internal audit needs to clearly define whether your onboarding process is is foolproof or not. You must know the credentials of the vendors. That's one. The second thing for a healthcare vendor, what is very, very important, and not only the commercials. For example, in our organization, we have the independent team which evaluates any new product which comes to us, even at an economical rate. We evaluate the quality. The quality assurance team will audit the quality and then only it goes ahead. So broadly, third-party vendors, the vendor selection process, that's point number one. Then when the vendor has been selected, it will include not the commercials would come later in a healthcare organization. Quality comes first. So the quality, the commercials, all those are important. The next most important thing, the performance of the vendors, the deliverables on the service level agreements. Is internal audit flagging off? Are there any differences when the purchase order has been placed, when the goods have been received, when the payment cycles are coming up? Even not only from the vendor side, it's also important to know whether my finance team, my payable team is ensuring the vendor payments properly. And if the vendor is a MSME vendor, there should not be a delay beyond 45 days. We'll end up paying unnecessary interest, and all those things will come into the picture. So these are very, very critical things which needs to be looked at from the deliverables from the vendor, the payment to the vendor, as well as the vendor complying with everything. I'll give you a simple example. When we buy a dialysis consumable, we pay GST, right, to the vendor. It's also important to see whether the vendor is paying the GST to the government.
Absolutely.
We had had notices where the government wants to know this, and luckily we were having things in place. We were able to address that. Otherwise, you will spend unnecessarily your bandwidth, your management bandwidth addressing that. So it's also important whether the vendor is complying with all those. If it is a manpower vendor, you need to check whether your outsourced employee, which you are sourcing from them, are their provident funds, the statutory compliances are being met properly. It's very, very critical. Otherwise, you being the principal employer, you will come under the government's lens and you will face the music.
Absolutely.
So those broadly, those are the things, whether it's a manpower, whether it is a consultation vendor, whether it is a vendor supplying you products and materials. So these are the things that needs to be looked at.
The third question is by one Mr. Pranav. He is asking views on control on effectiveness of hybrid work environment. My simple answer to that is I am old school. I prefer people working from office. As simple as that. Uh, yeah, it's the new reality where hybrid work environments do exist, but that really depends on how well is the task or the output defined. If the output is clearly defined, measurable, hybrid work does make sense. Uh, so that's my view. I'll still leave it to Mr. Indranil to answer that. He's probably in the other side. So
No, I agree with you, but the only point, only dimension I will add to here is what type of work.
precisely. Yeah. If
That's
it's
the
a measurable output, you can still kind of, still kind of be okay with it. But
So
otherwise, I
what
think
type
it's
of work is critical with a measurable output? I'll only go by
Yeah.
that.
So, Rajiv, I'll also add it, and both of us, have largely been doing internal audit for manufacturing organizations, multi-plant locations, field staff, etc., where you see that the people there themselves are, going to the plants or the field every day. So your expectation, you should not even have an expectation of a hybrid model there, because the action happens on the field, on the ground.
No. He's talking about specific
Pro-
cases where hybrid is possible.
Probably, yeah. So probably in a finance sector or in a insurance sector, it may work. Probably I'm not the right person to comment, but I've seen these models work in those sectors where people work 4 out of 5 days from home and yet deliver results.
Fair enough. The last promoter base, I think we've already answered that. So I guess that was all the questions. Real vote of thanks to all of y'all. Thank you so much for taking out the time. Thank you for indulging me and my questions. Greatly appreciated. Also, a disclaimer: most of these views here are our personal experiences, applicable in most cases, but again, they are opinions, not statements of fact. Really, thank you so much, Mr. Indranil. Thank you so much,
Most
Rakshit.
welcome.
Thank you so
Thank
much,
you.
Pinto.
Thank you.
Thank
Much
Thank you,
appreciated.
everyone.
Thank you so much.
Thank you, everyone. And to all the attendees, thank you so much. Have a good
Thank
day.
Thanks a lot. Have a nice day. Have a great weekend.
Bye-bye. Bye-bye.